Welcome to session 2.1. It's all about the analysis. We're going to be both horizontally, meaning going across, and vertically analyzing the financial statements to see what insights we can gather. So this particular video is all about common sizing, also called vertical analysis and horizontal analysis of the financial statements. Here's an example of horizontal. Horizontal means you're going across the financial statement. So as you can see, we have a base year, which is the oldest year, and we take any succeeding years in proportion to that base year. So we're looking across to see how much the particular accounts have grown from the base year or the baseline. And so as you can see, they've all grown except for the long-term liabilities, which decreased $5,000 or 184%. So that's horizontal, going across to see what the change is from year to the base year. Whereas when we do common sizing, also known as vertical analysis, what you're doing is you're expressing everything in that financial statement in terms of 100% of something. So if we're doing a balance sheet, it's 100% of the total liability, total assets. So cash divided by total assets, other current assets divided by total assets, long-term assets divided by total assets will give you the proportion that each one of those assets makes of the total. The same with the liabilities and the shareholders' equity. It's all expressed as a percentage of the total assets or total liabilities plus shareholders' equity. So you're looking at the proportional or structural makeup. If I'm dealing with the income statement, notice the 100% is revenue. So we express everything in the income statement as a proportion or percentage of total revenue. Well, let's see how one of these works. Here's again that analysis, but instead of going across, we are now going to make net sales 100% and express everything else as a proportion of that. So as you can see, here we go. We can see that over the years in 2017 that our cost of goods sold was 65% of total sales, whereas in 2018 it's only 60%. So the size of cost of goods sold in proportion to total sales has decreased. Well, what has increased? Selling expenses increased, and thus total operating expenses increased. So we can see that the structural makeup is shifting, but is that true forever? I don't know. I need more data in order to really do vertical or common sizing of financials analysis better, because I need more data to see if it's a trend or just, a fluke for that year. So let's use our knowledge of common sizing financials to figure out which company could be which, because the structure of a company will differ depending upon what it does. So if I think about Bed Bath & Beyond, that's a retail business, whereas Kelly Services is a service business, Bank of America is a bank, and Hewlett-Packard is manufacturing, and it does also some service. So let's take number 1 and see. It has a lot of cash. It has a lot of accounts receivable. And oh, look at these current liabilities. It has a lot of current liabilities. It's in the service business because it has 0 cost of goods sold. I think it's probably Bank of America. And the reason I think it's Bank of America is that Bank of America's deposits, in other words, what the customers put in the bank, are a current liability because they are responsible to you and I for those deposits. We do want them back. They're promising to take good care of them. Whereas their accounts receivable are the loans that they make to other folks. And so that's the primary business that most banks are in. They lend money to others. They take in your deposits and they leverage or lend those to others to make a profit. Let's see about number 2. Number 2 has no accounts receivable whatsoever, but it has a lot of inventory. And what else does, and it has cost of goods sold, so it sells products because its sale is all about selling goods. So I think that could be a retail business that doesn't have its own credit cards, but uses other people's credit cards instead of having their own. Well, what retail business do we have? Bed Bath & Beyond. Bed Bath & Beyond buys things from others, marks them up, and sells them. So I think that right now, Bed Bath & Beyond could be number 2. Well, what about number 3? Number 3 has a lot of other assets, and it also sells goods, but it also sells services, so it has both cost of goods sold and operating expenses. It has pretty much in current liabilities, meaning that it uses other people's money to finance their operations. Well, given that, and they have some inventory, I think that it could be HP. So I'm going to write HP. Whereas this is Kelly Services. Well, what's left? Well, what's left for number 4 is, I did that wrong. This is number 4 is Kelly Services, and number 2 is Bed Bath & Beyond, isn't it? Yeah, that's what we did say. Bed Bath & Beyond. Now, can you see why number 4 is Kelly Services? They have a lot of accounts receivable, and they're 100% services, so they sell their services on account to customers that says, oh, pay me later. So a lot of their services are not cash services, but credit services or services on account. We also know Kelly Services has no inventory, and they're pretty lean, so they don't have a lot of property, plant, equipment, unlike Bed Bath & Beyond that looks like they own their stores or have long-term leases on their stores. And notice that Kelly Services also has a lot of current liabilities. So they're living in the world of credit and selling services. So I hope this has helped about understanding common size financials, also known as vertical sizing financials, and we also looked at horizontal financials.